Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Rima. With me, Sonal and Hormus. At 11 o'clock, markets are pretty flat. It's got a positive tilt. The Nifty is at 24,661. It's got a modest gain of about 42 points. Sensex higher by 180. The advanced decline ratio, though, is negative. We've got more stocks declining compared to advancing stocks. The mid-cap index is off from the lows, but it's still, staring at a cut of close to about 0.2%. IT is shining bright. Infosys has made a small acquisition. About $150 million is what they've spent to acquire a 75% stake. But I think the fact that they are spending, they're showing that aggression to get growth is something the street likes, because the Nifty IT index is up 1.5%. So it's not just Infosys, because this is a tuck-in acquisition. It's not very large, the amount they're spending or the amount of revenues, but just the fact that they're going after growth now. They're trying to expand into Australia and New Zealand, and that's sending a positive signal, especially because Nifty IT has underperformed so much. Year to date, it's down 18%. So given that underperformance, and there's a rub-off impact across the rest of the IT names too.
Some relief that's coming by, because we've been talking about those weak numbers, the layoffs that happened at TCS. So this is something that the street is liking. Rima, as Rima pointed out, Nifty IT is doing well. We do have Nifty Financials and Nifty Bank as well, which are supporting the Nifty. But it's been quite volatile in last couple of minutes itself. We did see that fall from the highs. Then there was a swift recovery from the lows as well. So we'll be tracking that closely. In terms of movers, this R itself, ITC is one name that should come up for you on your radar. That one is at the day's low. So is Asian Paints. So some of these consumer names should be on your radar as well. But it's a packed show today on Trading Hour. Today's big story features Mutur Finance, which is surging in trade after a strong Q1 performance. We'll also get you excerpts of our conversation with the management. Later, Real Vision Group's Raul Paul joins us in our special segment Crypto Corner to decode the latest trends in the world of cryptos. At around 11:30 a.m., George Joseph from ASK Investment Managers joins us to discuss market fundamentals. HSBC India's Yogesh Agrawal also joins us to discuss their latest report on India's passenger vehicle industry. And with that, let's go across to Hormus. He's here with us. He puts the spotlight on top movers in the market at this hour. Hormus, tell us more.
Relief for some, not for quite for the others. But look at CSB Bank today. Was down yesterday, down further today. Interestingly, was down a day before the results as well. Came out with results yesterday. It's a slight recovery from the lows of the day. At one point was down well over 8%. And with this, the stock has now declined almost 20% in the last 3 trading sessions. We've had almost 15 lakh shares change hands by this time of the day compared to a 20-day average of around 91,000 shares. And the stock has delivered positive annual returns every year since its listing, barring last year when it was down around 24 to 25%. Newgen Software is the other one on the positive side that snapped a 6-day losing streak today, almost 8% higher on that stock. We've already had 30 lakh shares traded compared to a 20-day average of 5 lakh shares. But despite this up move, the stock has nearly halved this year, and this comes on the back of the stock doubling in 2024 and going up even further, 5x move in almost a 4x move in 2023. Now, HPL Electric is among the top losers in the broader markets today, and this is the biggest single-day drop since February of 2022. This 12.5% fall today. We've already had 10 lakh shares changing hands compared to a 20-day average of 1.5 lakh, and courtesy of this fall today, the stock has turned negative on a year-to-date basis. But between 2020 till date, the stock is up well over 1,200%. At the start of the year of 2020, the stock was around 54 rupees, now at around 520. And Surya Roshni is the other one on the downside today. It's declined in 7 out of the last 8 trading sessions. Another 7% gone today. 7 lakh shares changing hands, a 20-day average of just 75,000. And it has also turned negative on a year-to-date basis. But unlike HPL Electric, this stock has delivered negative returns in 3 out of the last 4 years. Back to you guys.
Okay, all right. Thank you so much, Hormus. So some interesting names there from the broader markets which are moving around in trade. Quickly, let's take a look at the markets again. So some sell-off from the highs, not a major one, but 40-point uptick on the Nifty is what we are witnessing currently. Mid-caps are the ones which are underperforming. And as Rima pointed out earlier, declining stocks more than the advancing stocks as we speak. But it is our time for a special segment, the big story, where we highlight key stocks or themes and deep dive into their financial and historical performance. Today we have Gaurav joining us on Mutur Finance. That stock is buzzing in how. Gaurav, how did the numbers look? What worked well for this company this quarter?
Well, when we look at the quarterly numbers, they were definitely better than what the street is expecting. So let me take you through the numbers first. Net interest income that increased almost by 51%, while the pre-provisional operating profit that increased almost by 62% on a year-on-year basis. Now, both these numbers were higher than the street's expectation, and as a result, profit that increased almost by 90% on a year-on-year basis. Now, this is actually 22% higher than the street's expectation. When it comes to AUM growth, it delivered strong AUM growth of around 42%, with gold itself growing at around 40% on a year-on-year basis. Now, what actually went right with the company this quarter is that there are two factors which led to 400 crores of extra income for the company in this quarter. Now, when we look at the breakup, company received 700 crores as recoveries from NPA, and as a result, around 300 crores is what went into the interest income. And second is that they also received 100 crores from the asset restructuring company. As a result, when we look at net interest margins, they have expanded almost by 100 basis points. Companies' yields have expanded almost by 100 basis points. So definitely that was something positive. And even when we look at the asset quality, there also we did not see any concerns. In fact, it has come down to 0.15%, which is actually very great. It is lower, at least in the last 6 quarters. So definitely good set of number is what company has delivered in first quarter.
Gaurav, just coming back to that point, you said that there was this extra income of 400 crore in terms of interest income, which boosted the company's performance in Q1. So does that mean this performance is not sustainable going forward? Because loan growth is very strong, 40%, plus even on the other parameters, it's looking good. I mean, what did you take away from the management when we chatted with them about the sustainability of this kind of a performance going forward?
Well, yes. This 400 crore, this has actually contributed around 100 basis points in terms of yields in this quarter specifically. Now, what management is saying is that in the last few quarters, we have seen yields maintaining at around 18.5% and spreads maintaining at around 9.5%. Going ahead, they believe that spreads and yields will be maintained in the same range. The one-off impact, which resulted into 19.5% of yields, now that won't be there from the next quarter, but definitely they sounded optimistic when it comes to yields and spreads. In fact, what they're also saying is that in coming quarters, the cost of fund is likely to come down almost by 40 to 50 basis points, but this benefit will be passed on to the customers and they will be protecting their spreads to 9.5%. In fact, when it comes to loan book growth also, we have seen management actually guiding for the loan book growth of around 15% even in the last year, but they had fairly delivered well above 40% in this quarter as well. Management's commentary suggested that at least for this quarter, they have maintained the guidance of 15%, but the result and the overall growth will be definitely stronger than the 15% guidance. So there is also optimism. That is what we have seen from the management commentary as well.
Optimism there showing up on the price as well. But Gaurav, there was a lot of talk about Muthur's numbers. Now, how do they compare in line with their peers for the likes of Manappuram and so on? How do the numbers look like on that front?
Well, from Manappuram, we saw some kind of disappointment in this quarter. In fact, when we look at the loan book growth, AUM growth actually declined almost by 1.5% in this quarter from Manappuram. Although when we talk about the loan book growth, that was strong at around 20-25%. But definitely some kind of pessimistic commentary is what we saw from the company. What they said is that in the coming quarters, the gold yields are expected to come down almost to around 18%. And they also said that the loan book growth for gold will be stronger. But there was some pessimistic commentary on the loan book, the gold yields. And that is the reason why we saw some weak set of numbers. But as compared to the Mutur Finance, they do not see any kind of worries. In fact, they said that the spreads will be maintained. So that is something which was positive for Mutur Finance as compared to Manappuram Finance in this quarter.
Okay, so Gaurav, let's wrap it up. Tell us, how did the valuations look? What are the brokerages saying now?
Well, when it comes to valuation, currently, if you look at Mutur Finance, it is currently trading at around 3.3 times price to book 1 year forward versus its 5-year average of around 2.45. So it is a bit higher than the 5-year average, but definitely currently, if we look at the brokerages, they are being bullish. In fact, 60% of the brokers who cover the stock are maintaining their buy call, and only 16% of them still maintain the sell rating. When we look at the target price, it is as high as 3,000 rupees. In fact, today itself, we have seen brokerages actually increasing the target price. In the likes of Morgan Stanley, they have upgraded the rating and also upped the target price to 2,920. We have CLSA, who increased the target price to 2,740. And in fact, we also have Nuvama, who increased the target price to 2,993. So definitely a bullish call is coming up from brokerages as well. So all in all, when it comes to numbers, they delivered good numbers. When it comes to commentary, they delivered very optimistic commentary, and now brokerages are also being bullish about the stock. In fact, when we look at the stock performance in this year itself, for the last 1 year, it has given returns more than 50%, which is higher than the market. So definitely an impressive performance is what we have seen from the stock so far.
Okay, thank you very much for that. So valuations high, double of that of its peer at 3 times price to book. Manappuram is at 1.5 times, higher than its long-term average. But this is the second consecutive quarter where they've delivered a loan book growth of 40%. And the street likes that. Actually, let's listen in to what George Alexander Mutur, Managing Director at Mutur Finance, had to say.
I don't want to change the guidance now. We've always said the 15%. Give us a little time. So usually we change the guidance after second quarter. So give us a little time. But for definitely, it will be definitely much better than what we said, 15%. There's no doubt about it. 15% plus is what I said. That is not limited to 20%. Can be even better. So we will discuss on it after the next quarter. Anyway, I'm also here next quarter. One of the things, as I've always been said, has been good demand for gold loan because of the overhang or the difficulty in getting unsecured loans everywhere. So that is one thing. One of the important things was, again, the regulatory action which came by revised final guidelines. The final guidelines, if you ask me, has been quite good, and it is quite gold loan business friendly. When I say gold loan business friendly, it is helping the gold loan business not only for the customer but also for the NBFCs and the banks. So the regulations which came gave a boost to the regulatory overhang which was always there, was whether the finance ministry, whether the Reserve Bank is keen to promote the gold loan business.
Well, time to take a short break, but just before we do that, the Nifty has come off slightly from the higher levels, now below that 24,650 mark. So Tuesday's high of 24,700 continues to be that bone of contention for the index, which it has not managed to cross. But at least for now, the index does seem poised to end its 6-week losing streak and end this week on a high. Of course, this being a truncated week. Now, take a look at some of the names. Rishabh Instruments is one of them, the top gainer on the small cap index, 16% higher on that stock. Take a short break, and on the other side, putting the spotlight on the crypto market with Real Vision Group's Rahul Pal.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back on Crypto Corner. Today we have with us Rahul Pal, who's co-founder and CEO at Real Vision Group. Rahul, hi, thank you so much for joining in. 2025 has turned out to be a very positive year for the crypto markets. Reports suggest that it is the future of finance. What are your thoughts on this?
Well, having been involved in this space since 2012, the idea for me was always that the financial system will move its rails from the old antiquated system onto the crypto rails. And that seems to be happening at scale now all across the world as governments have realized that this is probably a more efficient way to run financial markets. So we're seeing everything from the rise of stable coins to governments issuing bonds on chain to a whole number of different things. So yes, I think it accelerates from here because it's just a more efficient way of doing things.
Rahul, how would you read various geographies when it comes to crypto adoption? Because some countries seem to be doing very well while others are really lagging behind.
What we're seeing is different speeds run by different regions and different countries. You know, the US dragged its heels for a long time. Europe managed to pass its MiCA laws. China and India have been very stop-start in its adoption. The rest of Asia has been quite aggressive in its adoption. The Middle East, too, has been very, very forward-looking. The US, after the Trump election, has super accelerated. Now, the US is the backbone of the entire world's financial system, and they're now all in on crypto. So what we're seeing is other governments around the world starting to say, okay, if the US approves it, we'll approve it too. So we're seeing an acceleration and proliferation all across the world right now. I think it's been more difficult for India and China because of capital controls. But I think, there is a willingness within both of the countries to start adopting this technology as well.
Rahul, also comment on the crypto prices, that is, because we are looking at prices trading near all-time highs, but there also is a belief that we are very close to maturity. The last 3 years have seen lesser and lesser volatility. Would you say it is because institutions, high net worth individuals now are being part of this? Does that lead more credibility to the market?
I certainly think the credibility is on the rise. We've seen sovereign wealth funds, we've seen asset management firms, family offices for sure, all being involved in the space. And then we're seeing the financial system itself in the space, whether it's launching of new products or building on top of the rails. So we can see that. But really, when we look at the adoption of this technology, this has been the fastest adoption of any technology the world has ever seen, except now for AI. And that adoption curve keeps continuing. We're probably at about 600 million wallets around the world in crypto, and there's 8.5 billion people. So we've got a long way to go. Currently, the space is about a $4 trillion asset class. If you extrapolate the trend rate of adoption and assume it slows a bit as it matures, we still get to about $100 trillion by about 2032. So really, we're 4% of the way there. So it's still all to play for.
Rahul, what also seems to be doing quite well is the real-world asset tokenization. Those numbers seem to be increasing as well. And there are many people who are very, very bullish on this. What's your sense on this one?
I sense it's somewhat overinflated as a narrative, but in other ways underestimated. So what I'm talking about is things like tokenizing equities. I think that is going to be enormous because the size of the global equity market's at something like $200 trillion. It's a much more efficient way of settlement, transfer, storage, all of that kind of stuff. But I think the idea of putting real estate on chain and a lot of the ideas that people have, I think it's the people who want to sell real estate love it, but I'm not sure that many people actually want to buy it. And those that do buy real estate as a part of an investment portfolio, they tend to be able to buy it physically anyway or via instruments like REITs or whatever. So I think it's a two-speed thing. Definitely over time, anything with a title deed goes on chain, whether it's a driving license or a deed for a house or whatever. Over time will certainly go on chain because it's much more efficient. But I think real world assets makes it sound very acceptable for financial system and the newspapers and things like that. The reality is it's the other aspects of crypto that are probably even bigger.
How would you also look at the kind of push that we are seeing in US in sense of legislations, more reforms coming in? Of course, all of them very, very friendly, especially for the stable coins. What is the next step that you see within the technology, especially from US?
So I think the US, the next thing we will see is the full clarity on crypto regulation. Then we will see what they're going to do with the strategic reserve in Bitcoin. And then I think we have a very clear path forwards. So I think that only accelerates adoption within the US financial system. As we said, we've seen the banks building on stablecoin rails. The stablecoin explosion will only continue because it's a way of financing the US deficits by getting US dollars further out into the global financial system. So I do think we see that, and I think we see the rise of Bitcoin as a reserve asset, and then we'll see a lot more of the financial industry building on crypto rails. But we'll also see Web 2 using crypto rails for things like digital ID, which are going to be desperate in a world of AI.
Rahul, while 2025 is known as the year where we've seen all-time highs in Bitcoin and various friendly legislations and policies as well, but there is another narrative as well. While there is a lot of progress, there's not so much of protection for consumers right now. The year 2025 also is seeing the highest amount of heists and frauds within the segment. What's your sense?
Yeah, I think, look, if you use the phraseology that this is both finance and a new iteration of the internet, you are always going to have this problem. And regulation needs to be there to help protect consumers and buyers and investors. But, the internet itself is still rife with fraud. Every one of us every day gets an email trying to scam or phish us for money at vast scale, vaster than it is in crypto. And then if you think of the global financial economy, particularly the cash economy, it's the same thing. So I think what is interesting here is because we can record where money is moving on chain because it's immutable, it actually is very useful for government agencies to track down frauds and scam artists. But it's certainly there, and we certainly need some regulation to make sure that people are protected without excessive regulation that stops participation in this incredible opportunity for wealth creation.
Rahul, I'll wind down this conversation with one final question and your sense on where do you see Web3, blockchain and cryptocurrencies in the next 5 years?
So, as I said, I think we see the market cap as a way of thinking about the scale of this, moving from $4 trillion, and maybe within 5 years' time, we get somewhere close to maybe $50 trillion. So that's a huge increase in value. So that's what attracts investors. I also think we see the number of active wallets, so i.e. kind of the number of active users, rise from 600 million today to well north of 1 billion users, maybe 1.5 billion users within 5 years. So it's going to be a very prevalent way that we are going to be using crypto over the next 5 years. We'll see everything from transferring of money, storing of wealth, investing, building on the financial rails, and using the technology for things like smart contracts. So I think it becomes less of an exotic thing and more of a normal, regular thing that becomes part of our everyday lives.
All right, so less of exotic and more of normal in next 5 years is perhaps cryptocurrencies could be in the financial space. Rahul Pal, thank you so much for joining in with that sense on Crypto Corner. That's all the time that we have on this segment. But on the other side of the break, more news and updates follow.
CNBC-TV18 presents Crypto Corner.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Well, markets have come up from the highs, so it's a good time to get an F&O check on the market. Sudarshan is bringing us the latest trends from the F&O space. Sudarshan.
So F&O data is indicating that market is likely to trade in a range, with Nifty is currently holding on to levels of 24,600, while underperformance is coming from mid-cap space, with mid-cap index is currently in the red. But support, if you talk about the support, banks are today supporting when Nifty IT is up more than 1%. Now, if you take a look at the PCI, it's currently at the same level, that it was yesterday. It's currently at 1.08 versus 1.09. Even there is not much any indication from volatility index, it continues to trade up the level of 12. Now, if you talk about the options data on the call side, two options that continue to see healthy additions those are 24,700 and 24,650, and the put side 24,500 remains very active and 24,600 is active, and that's the reason support for Nifty remains around 24,548, that is 100-day moving average, and resistance, if you talk about, it's around 24,782, that is 20-day moving average. Two stocks that I have taken, one is Mutur Finance, after a strong set of earnings that company has provided for Q1 of FY26, with gold loan AUM rising almost 40%. Stock is seeing fresh longs. And if we talk about fresh shorts, amongst all the downside that you are seeing in metal names, one stock, that is NMDC, is seeing fresh shorts.
Thank you very much for that. Midesh is now back with us. Midesh, not changing too much, at least in terms of the index levels. What stocks are you picking up?
On the index, as you rightly said, not much has happened, but on the stock side, we have seen HDFC Life do well, and today I think ICICI Pru Life or ICICI Prudential is breaking out. So buy here with a stop at about 620 for targets of around 650, while HPCL Hind Petro, that's slightly negative with open gap down and then since has clearly turned negative. So in the short term, sell with a stop at 403.5, look for targets of 385.
Thank you, Midesh, for joining in with your views on the index and on specific stocks as well. Take a short break. From the charts, we move to fundamentals. George Thomas of ASK joins in on the other side. Stay tuned. Welcome back. George Joseph from ASK Investment Managers joins us now to talk more on the markets and the road ahead. George, good morning. Thank you for joining in. With the earnings season now coming to an end, where does the next trigger for the market lie? Because the policy is out of the way, earnings are out of the way. What does the market now look forward to for its next leg of up move, if there is a potential for that, that is?
Yeah, so if you look at it, the bond yields have been significantly lower, and that itself means that the equity valuations can inch up. If you look at the way the GDP growth has been very strong, the falling inflation, reduction of monetary policy rates, and also the improvement in the liquidity of the banking system, and the requirement for the central government to borrow in the market also has reduced. All put together, the bond yields have corrected significantly, which is very good from a valuation point of view. So if you look at from Nifty earnings perspective, I was just looking at the 47 odd companies which has reported in earnings. It has been fairly decent and probably better than the estimates. So almost 8-9% EBITDA growth as well as 9%, 8-9% PAT growth. So which is very interesting. So from a Nifty valuation perspective, we are very constructive, and we see there is a good amount of cushion in terms of the return potential in the next 2 to 3 years.
Okay, so that's the return potential for Nifty. George, I wanted to understand what's your sectoral bet now? Are there any sectors which are fairly valued? Because that's not something that we are seeing in the markets overall. So any specific theme that you think would work from here on? Because most of the export-oriented companies, they've spoken about what threat they would see if the US tariffs do continue the way it was announced earlier. Do you think domestic themes would work better?
Definitely. If you look at our market commentary, which we have published for the last 2 months, consistently we have been saying that we want to focus more on domestic-oriented businesses. That's where we see the leg up in terms of earnings growth as well as valuation comfort. So it's a decadal shift in the business cycle, which started in 2020, post-COVID. And we see that continuing in the next 3 to 4 years. So domestic-oriented businesses like cement, private banks, which has not worked in the last 5 years, we are quite constructive at this point in time. And that's where the valuation comfort is there. And probably what we are expecting in terms of earnings growth revision in the second half, as well as the GDP growth rebound and the rural economy also picking up, all put together, there is a good leg up in these domestic sectors visible. So export-oriented sectors, we are quite benign in terms of the visibility, and also we are quite light on that.
But domestic-oriented sectors are huge, right? There are so many to choose from. So tell us a little bit more. What are the stocks or themes that you like?
Yeah, stocks, it's difficult to discuss, but at the same time, the themes, what we like is the manufacturing theme, which we have been bullish on. And also, if you look at the infrastructure, capital goods sectors, so all the domestic-oriented sectors, specifically, I believe the valuation comfort is mostly in the private banks, structurally good companies, balance sheets have been fantastic. And also they have been going through various, integration and, various other issues, because of which, the stocks have not performed. And the big recoveries, which we have seen in the, PSU banks, probably that is the fag end. And, we will see more of the private banks getting re-rated in the coming years.
George, is wires and cable space a part of your domestic themes because of the fact that, of course, there is increasing competition, yes, but most of these incumbents have managed to withstand that, barring that initial knee-jerk reaction that we saw. Does that feature as part of your bullish themes as well, or are elevated valuations a concern?
Yeah, so we have been constructive all along, but the valuations is a concern at this point in time, and we are looking to carefully evaluate these businesses from the case-to-case basis, and also the merit in terms of the exposure towards US and so on and so forth. So we are not as constructive as we used to be earlier, but at the same time, obviously, as you rightly mentioned, the growth is quite strong in this space. So we are not as bullish as we were earlier.
Okay, what about specialty chemicals or agrochemicals, George? We've been getting very mixed commentary. Some of them said that this is the start of some recovery phase. Today, Deepak Nitrite said that maybe pricing pressure is not over. What's your take on some of these names?
We like some of these stocks, especially from the specialty chemical space. If you look at, it's a very diverse set of companies available in that. We need to do a lot of bottom-up research to arrive at that. We have a strong team in place who does these research very diligently, and that is where we think we can make a differentiation. So, looking at the space, in particular, specialty chemicals, we are more constructive there because most of these companies are coming out of a big lull period in 2024, and 2025 onwards, we are seeing there is a good green shoot developing, and in terms of the valuation comfort also is there. So many names in this space has been beaten down to dust post the big rally which we saw between 2022 24. Therefore, we are constructive there. So if you look at from pharma, generic pharma perspective, as well as specialty chemicals, we are more bullish on the specialty chemicals relative to generic pharma, which is more exposed to US.
Thank you very much, George, for joining in. Need to get into a break. On the other side, we'll talk about autos. Yogesh Agarwal from HSBC India joins in on the other side. Stay tuned. Welcome back. Now, HSBC has written a note yesterday which says that the Indian passenger vehicle industry, and they title it Rise of the Tail. So it basically means that in the last 1 decade, India's passenger vehicle market has consolidated. The top 6 OEMs, which includes your Maruti, Hyundai, Tata Motors, M&M, Kia, etc., they have increased their market share from 80 to 94%. This is over a period of FY15 to FY25. But some of the smaller players like Volkswagen, Skoda, Renault, Nissan, Honda, MG have seen their volumes fall due to uneconomic levels due to poor product pricing and fit. But now HSBC argues that some of these tail OEMs, the smaller ones, the Skodas and the Nissans we spoke about, are planning a comeback. And the next 5 to 10 years could be more favorable than the past. Now, this would have long-term implications for some of the incumbents too. Yogesh Agarwal, the head of research at HSBC India and the author of this note, is joining in on the show. Yogesh, first, just give us the big picture overview of this report that you have written.
Hi, Rima. So, look, Indian passenger vehicle market has consolidated quite a bit over the past 10 years. So 10 years back, they used to be 82% of the market. Today, almost 94% of the market is captured by the top 6 OEMs. And the bottom 8 or 10 are just 6%. So they have seen significant deterioration in the market share. And while it's going to be very tough to come back, but I think the overall backdrop is a little more favorable today than 10 years back for these guys to make a comeback. So that's the broader theme of the report. It's nothing very imminent as well, but something to keep in mind for the investors, for the incumbent OEMs in India.
But what makes you confident now, right? Tell me 2 or 3 reasons that make you believe that some of these tail OEMs will make a comeback.
Yeah, Rima, few reasons. Look, first of all, the cars in India are a lot bigger today. So in the last 10 years, the average ASPs have gone up by almost 100%. Today, the average price of the car is around 11 to 12 lakh rupees. So I think in bigger cars, it's easier for the global OEMs to come and compete and have a much bigger portfolio from just 1 or 2 cars in 1 or 2 segments. Secondly, even the customer evolution has happened. So 10 years back, safety was not the top priority for an Indian customer. Today, they all care for NCAP ratings and overall safety in the car. So those kind of things have also happened. The overall evolution in the taste and the requirements have changed. And thirdly, exports are becoming a lot more big from from India, and therefore, if exports could be a significant part of the overall volumes for any OEM, then it provides economic viability, even if you are relatively smaller in India. And last but not the least, there is just wisdom of hindsight, right? All the mistakes they have done in the past could be rectified in this time.
Okay, Yogesh, have you seen any historical precedents in other auto markets? If you can do a deep dive into that, where French players made a stronger comeback, if there are any examples on that, and how comparable is it to India's setup currently?
Well, there are many examples. So, for instance, Hyundai did very well in US over the past few years and gained decent market share. MG Motors did very well in UK. So there are examples where the OEMs can gain market share. However, I would repeat, it's not easy. I mean, look at China, for instance, on a very other extreme. There are probably 100 OEMs, but BYD is still almost 60% of the overall industry profits, right? So while it's easier to come back from a volume perspective, profitability will still be a challenge. But yes, there are examples from West as well as overall globally where OEMs have come back.
Yogesh, in a market as competitive as the Indian market is, and currently which is also going through a bit of a sluggish phase, if you could call it that, when it comes to demand, how difficult is it for any player intending to make a comeback, because the incumbents themselves are facing issues of their own? Does it make it easier for an incumbent to make a comeback if they have a differentiator product, say for example a Tesla in a hypothetical scenario, or is it difficult to get those numbers in a market like this with the situation that the current market finds itself in?
Yeah, look, India is always a tough market, but at least there is some wisdom of hindsight now. I mean, there were mistakes done by global OEMs. They didn't customize products for India. They just tried to they just try to force fit global products in India, right? So at least those mistakes could be rectified. And secondly, um, uh, there is an evolution in powertrain as well, right? From pure petrol and diesel, now we have EVs, we have hybrids, and if EVs do well from here and the penetration improves, I think that is a level playing field for the tail OEMs to come back. We have seen in the recent past as well, right? The MG Windsor just did so well from nowhere, coming from behind. So I think this evolution in powertrains as well is an opportunity for OEMs to come back. But yes, I agree with you. India is always a very, very tough market, and demand is weak. Although there is a little bit of a green shoot in July, and we are hoping for a better festive season. But yes, it's been a very, very tough year.
Just a quick word, out of time. So what are the implications for incumbent players? I know this is long term, nothing imminent right now, but what would be the call? And generally, what is the view on passenger vehicles and the long term picture?
Yeah, Rima, so look, as I said, first quarter was very weak. May, June were pretty weak, and nobody really knows. We saw weakness actually across consumer sentiments, not just passenger vehicle, across other consumer discretionary space as well. July, there is a bit of a green shoot, and we are hoping for a better festive season. But overall, we are still expecting a flat to minor growth this year, and we are coming from a high base from FY15 to 25. The CAGR for the industry was almost 5%, which in our view is the long-term potential for India, and therefore it is likely we will see a muted year. The good thing is new launches are coming, and a large part of the growth comes from new launches every year, and therefore this could revive some demand in the near term. I would also make a point that there is always this narrative that India car penetration is very low, like we have 30 cars per 1,000 people, and therefore it's a very high growth market. We have a different way to look at it. I don't believe that India is low penetration. India is a story of market expansion, because everyone who can afford a car already has a car. So it's about growing per capita income, and at later point, affordability improving. We are not low. Our penetration is not low.
Got it. Okay, all right, Yokesh, thank you so much for joining in with your take on what's happening with the automobile sector. That's the word coming in from HSBC, but we'll slip into a short break. We'll get you more on the markets on the other side. Welcome back. Well, we briefly dipped into the red, but we've recovered from that level as well. The pressure is led by IT names, so the likes of Tech Mahindra, Infosys, all of them are off the high. So are the banking names. So the banking index also is underperforming, but still in the green as we speak. It's the mid caps which are seeing some red right now. But with that, we'll take your leave on this edition of Trading Hour. Stay tuned. The team of Halftime Report comes up next.